Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China International Marine Containers Group Co. Limited Annual Report. China International Marine Containers Group Co. Limited offers a diverse range of businesses and services across various industries. The company's manufacturing segment includes logistics and energy equipment such as containers, semi-trailers, and EVDTB truck body products. In addition to manufacturing, the company provides design and construction services for offshore engineering projects, including semi-submersible drilling and jack-up drilling platforms. It also offers maintenance and reconstruction services for its platforms. The company's transportation segment includes road transportation vehicles, seaport passenger boarding bridges, airport baggage handling systems, and special vehicles for airport ground operations. Its logistics services include multimodal transport solutions, automated warehouse logistics systems, and automatic parking systems. Furthermore, the company provides finance lease, operating lease, and other finance solutions for customers in various fields. It also engages in industry city development and offers fire security solutions. In terms of equipment, the company offers energy, chemical, and liquid food equipment, as well as dry, reefer, and special-purpose containers. Its airport facilities segment includes seaport passenger boarding bridges, airport baggage handling systems, and special vehicles for airport ground operations. The company's services also include reusable transport packaging design and leasing, logistics solutions, and finance management. Overall, China International Marine Containers Group Co. Limited is a comprehensive provider of equipment, services, and solutions across various industries. China International Marine Containers Group Co. Limited market capitalization of $61 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that China International Marine Containers Group Co. Limited holds a significant advantage in their industry. China International Marine Containers Group Co. Limited trades at a higher price-to-earnings ratio of 520 times and a higher price-to-book ratio of 2.31 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified from various sectors within a company's operations. On the growth side, the energy, chemical, and liquid food equipment business saw a significant increase of 6.31%. While the offshore engineering business experienced an impressive 8.35% year-on-year revenue growth. The clean energy segment also witnessed a substantial 19.7% year-on-year increase. Furthermore, strong demand for LNG-related products due to trade-in subsidy policy and green transition in international shipping contributed to revenue growth. Additionally, newly signed orders totaling RMB 22.229 billion in 2025, with cumulative newly signed orders for offshore clean energy-related businesses exceeding RMB 10 billion, also boosted revenue. On the other hand, revenue decline was observed in various sectors such as containers manufacturing, minus 30.86%, road transportation vehicles, minus 3.91%, logistics services, minus 14.64%, and finance and asset management, minus 11.03%. The tank container market demand decline and policy uncertainty, leading to a slowdown in consumption growth, also contributed to revenue decline. However, it is worth noting that some sectors showed mixed results, such as the offshore engineering business, which experienced a significant increase in net profit, but no specific revenue growth mentioned. Similarly, the semi-trailer business saw varying results across different regions, with some experiencing revenue growth and others facing declines. The net income of a company underwent significant changes between 2 consecutive years. Initially, it decreased by 53.97% from RMB 4,088 million to RMB 1,882 million. However, this decline was partly offset by enhanced profitability in CIMC Wetrans, leading to an increase in net income. Nevertheless, the overall trend showed a decrease of 68% from RMB 4,195,157 in 2024 to RMB 1,337,376 in 2025. The profit margins also experienced a decline due to various factors. The gross profit margin of standard dry containers decreased, contributing to the overall drop in profitability. Additionally, intensified competitiveness and exchange rate impact further exacerbated the situation. As a result, operating profit margin decreased from 3.69% to 1.81%, while net profit margin dropped from 2.36% to 0.86%. The reasons behind these changes were multifaceted. The decrease in gross profit margin of standard dry containers was a significant contributor. Furthermore, intensified competitiveness and exchange rate impact also played a crucial role. On the other hand, a decrease in financial expenses by 141.4% and an increase in investment income by 76.6% provided some relief, but these factors were not enough to offset the overall decline in profitability. The company's financial performance indicates a significant improvement in its ability to generate cash from its core operations. The data shows that the net cash flows from operating activities have increased substantially over the past year, with RMB 18,514,449 generated in 2025 compared to RMB 9,263,870 in 2024. This increase suggests that the company's business is becoming more efficient and profitable, allowing it to generate a substantial amount of cash from its daily operations. The consistent trend across multiple pages further reinforces this conclusion, providing clear evidence of positive operating cash flow. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, short-term borrowings decreased by 23% from RMB 11,260,716 to RMB 8,679,781, indicating a reduction in short-term liabilities. However, this trend was reversed on page 55, where short-term borrowings increased by 142.4%, while long-term borrowings decreased by 38.7%. The total liabilities also saw an increase of RMB 81,499,310 from 2024 to 2025. In terms of interest expenses, the company experienced a mixed trend. On page 20, interest expenses decreased by 21% year-on-year, while on page 36, they increased by 48.97%. However, on page 56, interest expenses decreased by 23.6%, and on page 62, they increased by plus 825,010 compared to plus 749,266 in 2024. The overall increase in interest expenses from 2024 to 2025 was RMB 1,508,467. The company's performance varied across different segments and regions. On the positive side, non-listed sectors such as fund concentration saw significant growth, while listed sectors benefited from increased deposit limits. The logistics field, particularly container manufacturing businesses, is expected to experience a surge in container trade volume. Additionally, airport facilities and logistics, energy equipment, road chemical and fire safety, finance, containers manufacturing, and road transportation equipment, engineering services management all reported operating profits. In contrast, some segments struggled. Offshore engineering equipment services incurred an operating loss of $1.29 million. Airport facilities and logistics also experienced a decline in performance, as did energy, chemical, and fire safety equipment. Furthermore, offshore rescue and asset unallocated segments underperformed. These poorly performing segments will require attention to improve overall company performance. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has paid out to its investors in 2 consecutive years, 2024 and 2025. The amounts distributed were RMB 0.176 per share in 2024 and RMB 0.179 per share in 2025. In addition to dividend payments, the company has also been actively buying back shares from the market. In a significant move, it repurchased 146,179,540 shares, which has resulted in a decrease in treasury shares. This strategic decision not only boosts shareholder value, but also demonstrates the company's commitment to its investors. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal a worrying trend of potential inventory buildup and supply chain disruption across several industries. In the containers manufacturing sector, revenue has decreased by 29.05%, page 10, while cost of sales has increased by 106.58%, page 11. This suggests that companies may be struggling to manage their inventory levels. Furthermore, industry-wide inventory levels in North America are high, page 13, and customer demand is decreasing, page 13. The accumulated sales volume of dry containers has also decreased by 35.2% year-over-year, page 12. These statistics indicate a potential surplus of inventory, which can lead to supply chain disruptions. The report also highlights the impact on companies' financials, with a decrease in revenue of 14.64% and net profit of 16.65%, page 16. The container shipping industry is entering a stage of structural supply imbalance, page 26. Adding to the concerns about inventory buildup and supply chain disruption. The increase in accounts payable with aging over 1 year by RMB 743.914 billion from 2024 to 2025, page 77, further underscores the potential for supply chain disruptions. These scattered but consistent warnings suggest that companies should be prepared to address these issues to avoid further complications. That concludes the financial summary for China International Marine Containers Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.